Hi, I'm Jonathan Jay, and I want you to meet Sam Turner. Sam Turner was on my mastermind program in 2020, and since then, he's bought £17 million worth of businesses. And you know what? He started off as a footballer. Watch this video to find out how he did it. Now, if you're serious about buying a business, in the video description below this YouTube video, there is a link to a brand new free training program, no cost whatsoever. If you watch that training program, it will give you the essentials of business buying. And if you love this type of video, then like the video, subscribe to the channel and click the notifications bell, and you will receive a notification the next time I release a brand new video on buying a business.
So Sam, you joined Mastermind in 2020 and you've done an awful lot since then, but I imagine you had also done an awful lot leading up to Mastermind. So give us the background story. What led you to the world of business acquisition?
Yeah, it's probably not the most orthodox route, I would say. So my first job when I left school was playing football. So I played for my hometown club, Luton Town, for just over 2 years, kind of full time. In the end, I wasn't quite good enough, so I kind of dropped out of that and fell into. It sounds strange, but fell into the world of finance and accountancy. And it's partly because my father was an accountant, so that was the kind of the route there. And it was just something that I was always comfortable with at school, around numbers and that sort of thing. So I kind of fell into that, and basically. I spent the majority of my career, so 20 plus years, in the travel industry with a company that most people will know, which is Tui, which is the largest kind of tour operating business in the world. So I spent a number of years, got promoted sort of every year, and I was promoted on the back of wanting it more than other people.
Okay.
I think and I think that came out a little bit from the football side. So,
Well, I was going to say, I wondered whether there's a link between a competitive nature and wanting to win.
Yeah.
Because I guess that's the fundamentals of most sports, isn't it? And working your way up the corporate ladder quickly.
Definitely. I think, I mean, for anyone that's been through that experience, and probably it was tougher then than it is now, because these days, we wrap everyone up in cotton wool, don't we? But in those days, it was a pretty tough existence being an apprentice footballer, where you're at the kind of entry level of the club. You've got to do everything for the first team, and you get treated not so well, let's say, but you've got to man up, I think is the point. So I learned to man up and grow up quite quickly. And the second one was this insistence on winning at all costs, and dying for the cause, so to speak. Again, I think they've probably changed the philosophy a little bit in more recent times, but that definitely rubbed off on me. And that's I think when I left playing football, I was really determined to do something and find success somewhere, because when I left, and in fact probably the first couple of years, I was a little bit depressed, because I was this guy who had always been known for playing football, who was the guy that played football at school and, played for the accounting and got England trials and all this kind of stuff. And then all of a sudden I was out of the game completely. And what was I going to do? It was and some of my friends went on to do, be very successful playing football. So those first couple of years were tough, watching your mates in the papers every week, and you're thinking, what are you going to do? So I think that's what drove me, I think, to work very, very hard. So I studied for my accountancy exams, got through those, which were sort of 2 or 3 years whilst I was working, doing that, and I sort of progressed literally every 9 to 12 months probably in the career, and ended up in sort of fairly senior roles in TUI in the UK. I was finance director of the airline side of things, and then responsible for all of the sort of consolidation of all of the results for the UK business after we merged with First Choice. It was Thompson and First Choice used to be in the UK.
Okay.
So anyway, we about a year post that that merger, so that was my first taste of sort of integrating companies. And we were delivering something like 120 million of synergies, which I was sort of quite integral to understand how we were going to do that and plan that out and track, making sure that we were driving that. I got the opportunity to move abroad. So there was a division of TUI that was based in Spain. and they were after a finance director for that division. So I moved back in 2008 to Spain to be the finance director of this division. And again, this business, when I joined, it's a business called Hotel Beds. It's a B2B business, so it's not a consumer brand, but it powers a large number of travel providers. So if whoever you book travel with, chances are they've purchased their accommodation through a wholesaler like Hotel Beds. And
Okay.
Hotel Beds was the global leading business. When I joined, we were doing something like $750 million in sales. And we grew. It was a great journey. It was growing internationally. We were going into new markets, putting infrastructure in place, adding sales capability. We grew from 0.75 to 3 billion in organically in about 6 years. So every year, 20-30% growth. It was phenomenal. Good times. And then we were sold, because we were on a roll. We were sold by Tui. They were sort of cashing in on their one of their let's say non-core businesses, because we weren't core to the business, but we were businesses that were doing very well, high growth. So we were sold to private equity, to Cinven, which is UK based. It was a 50-50 actually between Cinven and the Canadian Pension Plan Investment Board, which tend to have sort of long-term hold investments, and they've got billions and billions to invest.
Yes.
So we were sold for about 1.3 billion euros. So the multiple at the time was quite a hefty one. It was something like 12 or 13 times EBITDA, which was, when I look at what we're looking at businesses now, seems like
Yes.
an incredible multiple to pay. So that was an interesting journey through private equity. By this stage, I had moved out of the finance function and was leading the commercial functions, because I wanted ultimately to kind of be more into general management as opposed to being a specialist in one area. So I led the sales team, I led the sort of buying teams, all the relationships with the hoteliers around the world. And we then, after being acquired by private equity, we then bought they then bought our two largest competitors, and we set to integrate three businesses together. So the 3 billion became 6 billion of revenue. So quite a journey.
You spoke to one of our mastermind groups last week.
Yes.
And I remember you saying that as a result of that integration, you decided that with your own acquisitions, integration was not going to be something that you really wanted to do.
Yeah, I think I'm not going to criticize my former company, because I think the decision was probably the right one. And the reason for that was, and I think I mentioned last week, is if you've got a very, very similar value proposition for customers, very, very similar business model, then why wouldn't you look for the cost synergies as part
Sure.
of that? Okay, so
It makes complete sense.
It makes complete. It's painful.
Mhm.
And there's always the dis-synergies that nobody wants to listen to, and you have to kind of be mindful of that. And we did naturally take our eye off the external world for probably 18 months. It was a difficult process. But in the case which we'll come on to, I guess, is I'm not looking at exactly the same businesses. So I'm not looking, it's not like a cookie cutter, every business is identical, and therefore probably it makes sense to put onto a single platform, single system, single management.
Yes.
They're all slightly different.
Unlike, for example, dental practices or veterinary practices where they do the same thing. So,
absolutely.
So I realise we haven't told anyone yet what it is that you've bought. So give us the summary of what you've done in the last couple of years, so we can appreciate where you are now, and then we'll go back to each of the deals and how you did those deals.
So I'd moved from Spain, spent a little bit of time in Singapore in the middle, and then I'd moved to Switzerland after we acquired these two businesses. We then set about integrating the two businesses or the three businesses together. And at the end of that, basically, I was
If you're curious about buying a business, if you are wondering whether it's something that you could do, then I've put together a brand new training that's going to be absolutely perfect for you. There is a link in the video description below. Click the link, watch the training, and find out whether buying a business is something that you could do. And if you like this type of video, remember to like the video, subscribe to the channel, and tap the notifications bell, and you will receive a notification every time I release a new video on buying a business.
I was done with the kind of corporate life. I mean, I was fed up with being on a plane every week. I was fed up with the politics. I was fed up with not really being in control of my own destiny, so to speak. And I came to a very amicable agreement with the company, and we're still on very good terms. And had some time to think about what it is that I wanted to do. And I think I mentioned this the other week. Not many people have the chance to actually really think about what they want to do. And you ask most people, and they really struggle to kind of say, what is it that you really
Yeah, they
want?
do.
And it's like, I've never really thought about it. And it's like I had that time to really think about what it is that I wanted, what I was good at, what I enjoyed doing, where did I want to spend my time, what was important to me. And as a result of that, I came up with a very clear vision, if you like, of building a group of SMEs, so small mid-sized companies, where I could add value, but where they could collaborate with each other for the greater good of the group, so to speak. And collaboration is a kind of strong value of mine. And the reason I chose that is, again, sort of listing down what I was good at and what I enjoyed. I'm quite good at, so I've got the sort of finance background. I'm quite good at the numbers. So the whole M&A type stuff is I'm quite comfortable with that, and dealing with investors, looking at returns, dealing with banks, looking at risk and these things. And then the other side of it, I used to, in my sales capacity, we used to deal with a lot of small businesses that were buying from us effectively, so helping them grow. And I really enjoyed actually helping a small business to grow. So it's the kind of combination of going between those things I really enjoy. And I felt like I could make a difference for those businesses that were going to be part of the group. We could make a difference to their management teams. We could make a difference to their teams, to the employees, to their customers, and that's kind of what I really want to do, and ultimately we can create some wealth in the process. But that's kind of what I wanted to do. So I initially didn't know which sector to look at. I think when we first started, I was unclear about where it was going to go.
Which is not an
No,
unusual
I think it's
situation.
quite common, isn't it?
When you've got a blank canvas, when
Yeah.
you've got all the options available to you, it's looking for something that that allows you to achieve what you want to achieve, which is going to be different for everyone.
Yeah. So I think I probably spoke to maybe 20, 30 companies initially before settling on which was the kind of area that I wanted to look at.
Oh, interesting. So different companies, all different sectors.
All different sectors, from e-commerce to furniture companies to heating companies, which is where we've kind of focused on now, to sportswear companies, to gyms, to coffee shops.
Oh, right. See, I didn't know that. So,
Yeah.
so you treated it as a research project, really, didn't you?
A little bit, yeah, because I had an initial criteria, and then I just kind of refined that criteria as I went through those conversations. Because it's only when you go through those conversations you start to learn a little bit more about the industry, about the numbers in the industry, about the dynamics, about the market, and therefore I refined that criteria over time to come to a point where there was only then a number of things that ticked the box. And it just so happened that what I'm doing now is does tick that sort of investment criteria, and the investment criteria were not rocket science. I mean, I wanted to buy lots of companies or acquire lots of companies. So I wanted a large market that was fragmented, so lots of companies. That wasn't rocket science, so I could understand it. That wasn't going to be overtaken by Google and Amazon tomorrow. I'm not a techie, so that's something that's and people that know me will laugh at that, because I probably the opposite of a techie. that was.
I can associate with
Yes,
that.
I'm sure you can. Yeah, yeah. We're alike on that basis. And that was quite resilient in sort of downturns. So I had 2 or 3 sectors that would sort of fall into that category, but the sector that I landed on and I'm now developing is the HVAC, so heating, ventilation, and air conditioning. I would say the wider what they term M&E, so mechanical and electrical services.
Okay.
Focused primarily now growth on the sort of commercial customer base rather than a residential customer base.
So just for clarity, so everyone can get their heads around this, do you manufacture or do you just install?
No, so it's install, service, and maintain.
Got it. Okay.
Yep.
So the installation part, I guess that is a one-off,
Yep.
Transactional,
Yep.
Relationships, and then the service and the maintenance is the ongoing recurring revenue.
Absolutely.
Brilliant.
Yeah,
okay.
Absolutely. So that ticked a lot of those boxes. It just so happened that a very close friend of mine owns a business in the heating space, so was able to provide a lot of support in the beginning when I knew nothing about the industry, and has been proved helpful on the first acquisition, especially. So that kind of ticked the boxes. So that's what I'm doing. So I have the vision, if you like, for the group now is to arrive at to be the leading platform for independently managed HVAC and complementary businesses. So it's a platform. We're not going to consolidate the businesses together. Coming back to the point, they're all slightly different in nature. They're all independently managed. They'll retain their brands, their management teams, their culture, etc., etc. But
so let's explore that for a moment, because it's an interesting approach, a very good approach. So the question I get asked a lot is about rebranding. Do you rebrand a business? And my standard answer is that the brand, the name, the reputation is part of what you've bought.
Yes, absolutely.
So you wouldn't buy Boots the chemist and say, well, actually, I'm going to take Boots' name off everything and put my name over the door, because the brand is what's important. But people always also want to know, despite that, so if you keep those individual brands, do you consolidate the back office?
Yeah.
So do you have one finance system? Do you have one HR function, one marketing function? So how do you do that?
So I think to take in each point, you're right in that, number one, we're buying what are effectively service companies. They don't make anything. So the brand equity, so to speak, is actually important. The reputation in the market is part of what you're buying. You're buying the people, the contracts, and the reputation. So I think it would be honestly crazy to try and think about a rebranding of that, at least initially. And we have no plans to do that. We might modernize the logos and stuff like that, but in terms of the name, the heritage,
it's disruptive, isn't it?
It is. I mean, it's an emotive topic, right? So, and the classic kind of the classic mistakes that some, new owners have made on businesses. They might be big trade company or trade sales where they then sort of rebrand, and it's a classic case of ego driving decisions. So I have no intention on doing that. I think there's really no value. Where there is value, I think, from a branding perspective, and then I'll touch on the back office piece, is I think it makes sense for people to know that this company is also now part of a network of companies. So I think the case of some sort of, and we haven't fleshed this out in detail yet. In fact, we've got an exercise around branding in the next couple of months for the group, and we'll think about this. Is I think it makes sense to have some sort of umbrella brand or an umbrella. You would think over the top, but more sort of almost like a part of.
Part of the family.
Part of our brand is Advantos, or powered by.
That's sort of something that brings it together.
Exactly, because that tells people and those stakeholders that you want to tell. It tells suppliers that you're a bit bigger than just this one business. it tells customers that actually you might be able to provide the services that I want over here as well. So,
Yes.
which is exactly what we want to do. It tells employees there might be some more opportunities
It's
than
true.
just in this business,
Yeah.
which is exactly the type of value and the positive difference that we want to make to
It
to the
signals
stakeholders.
stability, doesn't
It
it?
does.
Sorry for interrupting your video, but I wanted to introduce you to a great lawyer in the UK who can get your deals done for you. He's worked for 50 of my mastermind clients in the last few months alone. His name is John Andrews, and I've got his details right here in my little black book of contacts. You can phone him on 0345 241 2494, or you can email him on johnandrews.deallawyer@jmw.co.uk. If you want someone who can get a deal done, he is your guy. So let's get back to the video.
Yeah, it does. So that's that's on the branding front. And again, if I go back to my previous company, we actually removed the brands of the other businesses. Now, whether or not we timed that right or not, I'm not sure. But I, the exercise that we went through was, again, is what's the brand proposition? What is this brand actually doing for the market? And if it's doing almost the same as what this brand is, maybe it's better to get behind one brand. So that may make sense. But in our case, when you're dealing with smaller businesses, when they've got a legacy, they've got a culture, they've got a reputation in the marketplace, you want to protect that and sort of enhance it rather than damage it.
Yes.
The piece around the back office is an interesting one. And my take on this is, when I'm communicating to business owners or the teams of the businesses then that we're acquiring, my starter for 10 is we're not looking to integrate back offices. What I will entertain is opportunistically, if there is an option, because I don't know, let's say the finance manager in one business leaves and actually we can cover that from another one, we might look at that. But it's not going to be front and center of what we're trying to do.
It's not going to drive your decisions.
It's not going to drive our decisions. We want to focus on the margin side of the business, the revenue synergies, the margin synergies, the buying synergies, all of those things that can be got at through collaboration between the companies, rather than what is a very, very disruptive
Yeah, it is.
nature of.
Believe me, I know. I mean, it's and the more times you do it, the more disruptive it becomes, and it becomes a distraction actually from why you are really there.
Yeah.
Trying to figure out how to get all these finance systems to talk to each other, is that you might as well let it run and put an extra person in to oversee it, rather than disrupting all of your staff, all of your customer and supplier relationships.
I think sometimes it it's horses for courses. I think, like we said before, if you've got a cookie cutter approach, then it makes sense to be on a single platform, probably. If you've not, then why am I going to force this business into this system where this system doesn't cope well with this business model?
Yeah.
It just doesn't make sense. We have businesses that are more construction related, and we have businesses that are more, let's say, commercial maintenance related. They're actually quite different in their business models. So it may be over time that we have a suggested platform system for this type of business and a suggested platform for this type of businesses, because some of the businesses that we buy don't even have a system apart from the finance system. Everything's kind of manual. So if we then choose to move towards one, then we'll go to one that we're using over there because it makes sense to do. But we're not going to say, right, tomorrow you rip up what you've got and you move everything over here. I just think it's too disruptive, and I think there are more opportunities to go at than that.
I agree, and that time and effort could be put into the next acquisition, couldn't it? Otherwise, you're focusing inwards all the time.
Yeah.
So, to bring this into focus, you've done three deals.
Yep.
So, what's the annual group revenue, just so we can get a sense of scale?
Yeah, so we'll do probably just under 17 million of revenue for this year, the year ending June, so in a few months' time.
Okay, fantastic. And has that grown since you took over these three businesses, or is that what you bought?
So the first business was doing 5 million when we acquired that, and that was only 15 months ago. So December where are we now? This is March, isn't it? So yeah, about 15 months ago, December 21.
Oh, so the first deal was 15 months ago.
Yes, the
Oh,
first deal
right.
was 15 months
I
ago.
hadn't appreciated that
Yeah.
you've done all of this in the last 15
Yes,
months.
yes, yes,
Right.
yes.
Okay. Well done.
And the fourth one is in the process now. So we signed heads of terms last week. So that's
Fantastic.
that's good.
Oh, congratulations. That's wonderful.
Yeah, so the first one was 5 million. That's going to do 6 million this year. So we have grown that business, and then the other two, we're only joined the group in one in July and one in August. So it's kind of
Right.
6 months, 7 months in. So it's kind of
Absolutely.
first year.
So you don't expect to see any immediate growth. It's about getting your feet under the table and actually understanding what you've bought.
No, absolutely, absolutely. I think the other thing with regards to what we're trying to do is the model really is to try and replicate what we've done, adding more and more businesses at that sweet spot of between sort of 500,000 to maybe 1.5 million of EBITDA, paying a reasonable multiple, so not trying to do anyone out of what they deserve, but paying a reasonable multiple for that in a good structure that enables us to use surplus cash in the business to fund any equity in that. So we don't need to then keep putting more money in. And I think it becomes then an M&A model, assuming that you've got some sustainable cash flows ultimately. So
Yes.
predictable, sustainable cash flows. So what we're looking for much more now, and you touched on it earlier, is the recurring or reoccurring revenue, where actually it's far more predictable, and therefore you've got this, unless you've got big churn in the contracts, you've got this predictable cash flows going forward. And more of those, we don't really need to be doing 20% growth in each business on top,
No.
In fact, if you told me they were all going to be stable for the next 10 years, it would probably be absolutely fine. We will look at obviously growing the businesses, but the model is based on its incremental growth as opposed to radical step changes, I think, in
Absolutely.
in the business.
If I can just come back to something that you said, and I want to make sure I've understood this correctly.
Yep.
So when you said that you use the cash in the business as the equity in the deal,
Yep.
If I read between the lines, are you saying then that it didn't require any additional equity from the shareholders?
So the first three, we did put some equity into each of those deals. The fourth one, we may or we may not. We're looking at a couple of options with that one, but probably we won't need to put that. It will come from cash in the business. But the model going forward, and this is based on then how much EBIT you can acquire, and what's the rhythm of that acquisitions, because if you do too many, then you'll need to fund
Yes.
more. But if you're generating surplus cash in the business, you probably want to use equity and debt. In my case, to make sure we don't have too much risk, you may use, I don't know, 2/3 and 1/3 or something, but that equity can be out of your existing group as opposed to needing to go and raise more money. And that's where you get really, it really can accelerate the returns on equity for investors and ourselves.
And are there other shareholders? Is it just you, or are there other?
No, so we
people?
have a number of investors. So roughly speaking, I own sort of 70%, and there's 30% with some investors, because I didn't want to. I mean, I had some capital to invest, and I was happy to do that to a certain extent, but I wanted to do that alongside others, and that's been sort of helpful in the first three. So we have about 7 or 8 individuals that have invested in the group.
Very good. It's actually a model I'm seeing more and more at the moment. James Gardner, who's bought some funeral care businesses, did exactly the same
Okay,
with his first acquisition. So you've done 3 deals, but again, if I just loop back to what you were saying earlier, you spoke to 30 different types of businesses before you settled on this sector.
Yep.
How many businesses in this sector did you speak to in order to find the 3 deals that you did?
Yeah, so I think it's something you mentioned before, and if you come from a sales background, it's the funnel, and it's a numbers game. So I think I ended up speaking to about 120.
Oh, really?
About 120 companies. I searched for companies via all different sorts of means. So yes, direct approach, through brokers, through suppliers and customers. for example,
Mm-hmm.
recommendations, referrals, being a little bit present in the industry and trade shows, being everywhere I possibly could to actually
Yes.
say this is what we're doing, because you need to tell people what you're doing,
Absolutely.
which people sometimes forget.
So,
And
so you spread the net
spread
very
the net.
wide, didn't you?
I think what I would say is, fingers in all the pies. My approach is to be everywhere.
Mm-hmm.
So I will talk to brokers. I actually employed the broker myself to be on the buy side to help me with some of the work, and one of the deals came through there. I did some direct outreach. I then, a number of different things.
In other words, you took it seriously.
Yeah. No, I think, yeah, I think, we set out with an investor kind of deck 15 months ago that was actually having a base case of getting to 40 million revenue and a bull case of getting to 60 million revenue by 26. And when I presented the other day at your session, my target was the 60 million at 26. So my intention is that we get to that number. So it's not, and coming from my background as a CFO as well, what you don't want to do is over-promise and under-deliver. Quite the opposite. So yeah, so now I've been quite public with the targets that we've set ourselves. We need to move and actually get some action. Otherwise, it's not going to happen. But I think we were talking before we came on air. What we're doing is it's not that complicated. And I say to people, it's actually quite simple. It's not easy, but it's quite simple. So there's the process. There's the steps that you need to do. But you need to do the work, otherwise it's not going to happen.
Yeah, I see this a lot. I see people, they want the outcome, but they're not prepared to put the effort in to get there. They really hope that you send out 50 letters and it's all going to land in your lap. Now here's a question though, because I'm always curious to know, because you said that your criteria sharpened, and I imagine it still is sharpening.
Yep.
Out of those initial, was it 120 conversations? Presumably they're sitting in an Excel spreadsheet somewhere. Do you think there might still be some deals in there because some of those businesses might have matured, seller expectations might have changed? It didn't fit at the beginning, but it fits better now as a bolt-on, but it certainly wasn't a platform.
Completely. And I think it's important to kind of try and keep that list. And what I did is literally in Excel, a little bit of characteristics about each business, so you can go back to them, because you might have the mailing list, but actually understanding, well, how big was it? What was the profitability of that business? What was the management solution in that business? What were the dynamics? And so we keep that, and it's I say common. I mean, it happens. It happened to me a few weeks ago when a guy sent me an email saying, look, we spoke a year ago and you actually made an offer on the business. It wasn't quite right for me at the time, but can we speak again? And we're speaking now, and we're almost at kind of, in principle, sort of agreed terms for a deal. So I think that's not done once you've got the list, once you've had the initial conversations. What I would say is probably, again, refining that criteria for us. Probably we're looking at slightly larger deals. So some of those probably wouldn't fit because they're probably slightly too small in terms of what we're looking at now.
Yeah, it's interesting because if a business was interested in selling a year ago, a year later they still haven't sold, they're often a little more malleable, shall we say, when it comes to price and terms, because usually things haven't got better; they've only got worse in terms of whatever circumstances were leading them to want to sell. So you've got incredibly good deal flow, which is critical. How many to get to that 60? How many more deals do you need to do?
Well, it obviously depends on the size, but we're saying to get to the 60, it's probably 5 or 6 more acquisitions. It could be less than that. We'd be open to looking at deals. We're looking at one at the moment that's got a 15 million in revenue and 1.4 million of EBITDA. Gets you there quicker. But I think what we've said is, look, anywhere between 1 and 3 deals a year for the next 3 or 4 years is kind of the rhythm that we think we can run at with the modelling that we've done around how much surplus cash we're going to be spitting off to reinvest into more cash flows.
If you grow too quickly, you need a lot more cash, don't you? That's the
it has to be dependent on that, and the group is doing Reasonably, well, I say reasonably well. I mean, one business is doing well, the other's okay, and one's struggling a little bit, but that's cyclical, market driven as opposed to
Hmm.
anything else. But it's still profitable, and we've sat on a little bit of surplus cash now, so that hence why we may not need to raise any more money for the next
Okay.
deal. But yeah, it's finding that rhythm where we're delivering the cash, and that's critical. I mean, profitability is one thing, but if your business is if you're paying if you're growing your businesses and you're paying your suppliers before you're getting paid, you're having to, you know, write a check for the working capital every month, and that's not what we want. So one of the criteria is it needs to be relatively neutral from a working capital perspective,
Yes.
so that when we grow, we're not having to fund it more cash. We don't want it to be capital intensive. So if there's a lot of capex in the business, again, the profit might be this, but you need to fund a lot of that into capex to keep going.
Yeah.
So these businesses are typically they're quite asset light from a capex perspective.
And something you said in your presentation to the mastermind group last week, which is something that we've said many times before, and you said it so clearly, was that the working cap negotiation is as important, if not more important, than the actual price and terms, because you do not want a business that requires a cash injection 3 months after
No.
you bought it. You want something that has surplus cash,
Yeah.
and that becomes part of the deal,
Yeah.
because that is just so much more critical. You almost
Yeah.
pay more for the business
Yeah.
to get the surplus cash.
It is, and you realise switching from me from sort of large corporate, which was always cash was never an issue. The whole entire business was focused on EBITDA and growth, into a small business context where, because of certain cycles, maybe one big customer over here, etc., cash is becomes critical. So then you're focused more around the cash. So probably on the first deal, I wasn't so focused on the cash, and probably we didn't leave the right level of cash in the business, and that's the one that we've probably struggled with. Although, to be fair, the market sort of has gone
For other
against.
reasons.
Yeah,
Yeah.
it wasn't just for that reason. But if we'd have had more cash in it, we wouldn't have had so many issues. So now that becomes a bigger part of the conversation, and I think that gets left out. Like you say, I think it's the headline price of the multiple of X.
Yes.
But actually, what you want to negotiate is to make sure that you're leaving cash in the business to service any working capital in the short term or the medium term.
I mean, there's so much that we can talk about. What we're going to do is we're going to do a second episode where we talk about what you've learned from integrating those businesses in the way that the unique way that you approach it, and what the plans are for the future and how you're going to deliver on those plans. So Sam Turner, thank you very much for this part one of our interview, and I'll see you back here for part two.
Good stuff. Thanks.